Welcome back to Understanding VC. I'm your host Rahul. Today my guest is Melody Koh. Melody is a partner at NextView Ventures, a seed stage VC fund investing in startups that are redesigning the everyday economy. Prior to NextView, Melody was a head of product at Blue Apron, where she helped scale the business through hypergrowth and to its IPO, building and leading a 35% team across product management, product design, analytics, and data science. Now let's talk to her. Hi Melody, thank you so much for joining me today.
Hey, it's good to be here. Thanks for having me.
So you grew up in Taipei and then went to school in the US. Why did you not go back to Taipei and decide to stay back in the US?
Kind of life just kept me here. That's kind of the short answer. But a couple other thoughts. It's funny you asked because the original idea of coming to the States for school was really that, in a couple of years build experience and kind of get the US street cred and go back to Asia. It was an interesting and exciting market. But I think as I moved further along in my career, I was really interested in early stage, whether it's on the operating side or on the investing side. And I felt that my personality and my style of working probably was more suited for the US work culture, which is more bottoms up, if, for lack of better description, than the working style in Asia, which from my understanding still is pretty top down and hierarchical. So I feel that I'd say the last thing is, I think about like the big markets. Unfortunately, Taiwan is not a big market. So you really have to go to China or Southeast Asia. And I feel like as someone who grew up in Taiwan, I didn't really have an advantage in either of these markets. So I had as
Yeah.
much an advantage of being in the US as an immigrant, which everybody here is pretty much, versus being back to Asia, despite I speak Mandarin and was native to the culture. So a variety of different reasons just kept me here, and now it's been 20 years exactly. Yeah.
Yeah. So what were your hobbies growing up?
What were my hobbies growing up? Playing video games, Legos. I was like quite a nerd. I so it's a little timely. So Diablo 4 came out. So it's funny. My husband actually bought it so that we can play together for like 2 hours a week. I have young children, so I really don't have time to do this. But we
Yeah.
played like 2 hours a week after on Friday night after kids go to bed. So I played Diablo 1 when I was in, I can't remember, like when it first came out 25 years ago. So I 1, 2, 3, 4, and then played a bunch of other games in a variety of genres. And I did like, there's a period of time in Asia where like these like racing cars are pretty popular. So you put them together and assemble them and go to
Yeah.
races. And I did that in middle school.
Yeah.
Very extremely nerdy. And in high school, I played Magic the Gathering. So and then growing up, Lego was like my favorite. But I also had this interest in like running a business, whatever that meant. I remember I don't think it was technically kosher, but I would like be like a sticker wholesaler, if that makes any sense. I would go buy stickers and I was like, oh, let me like cut them up in little pieces and let me like make money selling to my classmates. I don't think this is actually allowed, but I
Yeah.
just had these like random business ideas that, which I think later pushed me into thinking like, oh, I want to study business, as a high schooler, whatever that meant. Right. So
Yeah.
that kind of led to choosing colleges that had an undergrad business program for my kind of rudimentary understanding of business. But yeah, like playing games and things like that growing up.
Yeah. And the interest in business probably is also because your dad was an entrepreneur, you're telling me, right?
Right.
I mean, a lot of guests that I talk to on this podcast, they somehow, in back of their mind wants to be like their parents and what they did probably.
Yeah. Well, I never really wanted to work for my father. We were too similar in personalities that we would just clash all day long. But he started a software business when I was graduating from middle school, going to high school. So he basically was in the Navy for 20 years and got the Taiwanese Navy scholarship to study here for master's and PhD. So he was kind of like designing like missile defense system and information systems for the army, not like actually on the ship. So he was kind of a technologist, and then he started a software business. back then. And I just saw how hard it was. And then I also saw how kind of interesting it was. And over the years I got kind of indirect exposure of that. But that's not like a family business. That's like a professionally run, professional
Yeah.
management team style thing. So that one, it would have never make any sense to work with him. And two, I just really I would have not enjoyed working with him. But I got a glimpse of like, even for a startup, so to speak, how that looked like starting out in Taiwan. I mean, they had to sell to customer base all over the world because the Taiwanese market is just too small to support venture scale software business.
Yeah. So you're VC now. Couple of things I would like to know. As a VC, what are your core values?
What are my core values? I think one is really like honesty and transparency. I think that this is more related to how I like to have the relationship with the founders that we work with. And we're pretty hands-on as investor in terms of how we operate, meaning like we spend a lot of time with founders post investment to the extent that we can really be a kind of a strategic sounding board and be helpful. And in order to do that, I really do have to know what's going on with the business. And
Yeah.
we're also seed investors, so we're strictly focused on seed and pre-seed. So you don't really have to hide from me like what's going well and what's not going well, because I'm not going to lead your next round. So hopefully, like at the beginning of the relationship, we can really establish like a highly transparent and honest relationship, because I feel like that then you can put all the BS behind and really just focus on what collectively we can put our heads together to really advance the business. And I think so I think that's one that's very important. And then I think the other ones are really just about, we have some core ethos here in NextView that are really around the concept that, we're, if investors are invited guests to the founder's journey.
Yeah.
So there are a lot of things that we try to keep in mind when it comes to that. Like, we're invited guests, right? So we're not really running the show, and we got to be respectful in terms of helping clean up and show up on time and be prepared. Be prepared to read the updates and read the board decks before board meeting, which sounds really basic, but it's actually kind of a low bar. And like, read the deck before founders come into pitch, right? So you can go straight into these deeper conversations. So I just feel like it's such a basic, because founders' job is like 10 times harder than ours. Yeah. Oh, and the other thing really, right? Like, send past emails in time, right? Tell people like what your process is. I mean, we can't maintain 100% SLA, but we try to do as, close as we possibly can to that. I usually say, hey, give me a week, and then I'll get you an answer, whether it's no, in which way we get out of the way really quickly. Don't drag along. We're not going to try to hang around a hoop and wait for other people to decide what they want to do, because we make our own decisions. Or if we want to do more work, here's like the roadmap of work that we want to do. There's a level of transparency and timeliness, because founders are talking to tens, if not hundreds of investors. So the least you can do if you're not going to invest is just like let them know in a timely fashion, as opposed to ghosting, which surprisingly a lot of investors do, which, they spend a half an hour pitching you. The most you can do is spend 5 minutes and write a reasonably thoughtful email about why you're not going to invest. That's my opinion.
Yeah. So, you talked about transparency. So for a founder to be transparent and open with you, probably he need to trust you, right? So is there anything that you do to build that trust? Is it just about spending time?
Yeah, I think that honestly, spending time in person, during the diligence process and getting to know, like, I think, of course, during the peak COVID, people weren't able to meet in person, and I think that was doable, but that was not ideal. And I think spending time in person, sharing a physical space, and really get to know who the other person is as an individual, not just as an investor or as a founder, is helpful, at least to me. And I think for all the founders, helpful to them to really know, like, because you can be like, oh, I'm going to take term sheet from Firm X because Firm X has whatever, XYZ on their website. But I think a lot of it, especially at the early stage, comes down to who's the person I'm going to be working with? Do I enjoy this person's presence? Do I respect this person's opinion? And this is mutually. This is not just like founder to investor. I think investor to founder as well. And do I trust this person? And you don't have to be best friends. Like, you don't have to be like, oh, I want to, the criteria is not like, oh, I want to grab a beer with this person when I have a moment of free time. Because then you just end up investing in people who looks like you. But it's really about, is there like some kind of foundation to build mutual respect and trust? And I think there's no shortcut. I think a lot of it is just we spend time. One thing I've started doing recently, as of like last quarter, is when I commit to a new investment, like after the money is wired, the deal is closed, I do like a kickoff dinner, and I try to get together with the founder. No agenda. This is not even like a kickoff board meeting. It's just like a kickoff dinner to really like formally kick off our working relationship. And then during that kickoff dinner, we get to talk about family and kids and whatever else that is not just like, oh, what are the milestones you try to hit next quarter? And I think little things like that can really help. But I think the last thing I would say is that when you want other people to open up to you, you have to open up to them. So I think it's just showing a level of vulnerability as well. And that really helps as kind of a foundation of trust.
Cool. So you've been doing investing for a while. What is the most important lesson that you've learned so far as an investor?
What are the most important lessons? I think, this job, early stage venture, is a very hard job. And if you look at our portfolio and kind of historical patterns of our earlier funds, which I was not part of, that had been, vintage 10 years or 7-year funds, what we learned is that we don't really know which of these companies are going to really become meaningful value drivers of the fund. Not most of the time, not a Series A, not even a Series B. Sometimes, so there's a lot of level of randomness. And I think that's why I feel like the longer you're in this job, the more humble you become, because you really have no idea. Like, as an investor, I mean, this sounds kind of crazy. You're like, wait, aren't you guys supposed to know what you're doing? I think at the early stage investor, because it's such a power law distribution and we have very little data, I think then it's kind of, that leads to my another realization, which is, I think people talk about like, oh, founder, market, product, like what aspects you're trying to weigh, to what scale. I would say up until very recently, I was like, well, team is very important and market is equally important. But my latest thinking is really that if they're a founder that are truly exceptional, and this is where it gets tricky because the definition of exceptional is very ambiguous. If the team is truly exceptional, their ability to reach to the scale of upside is potentially 5x to the next average top quartile founder, then that's worth being in business with, because the downside is exactly the same. Downside is capped. Downside for every single investment, the downside is to go to zero, which it's not like you take more upside risk, you have more downside risk. The downside risk is exactly the same. So I think there's some founders that are truly crossing the threshold of you feel like you have conviction that they have the ability to really maneuver into whatever idea, space, industry that they're in, that the opportunity for exceptionalness is higher than the average. Then I think that's really what we're in the business of, to find those teams and really try to be partners with them, because that really is the driver for our industry and our sector specifically. But other than that, I think like it's just a level of humbleness, and then that, I think the only other lesson I would call out is, as someone who came from a building and operating background, it is easy to fall into the trap of, you pitch something and I'm like, yeah, that sounds good if you execute XYZ way. And the investor, come up with the XYZ. And then you talk yourself into like, yes, this is a good idea if XYZ is done. And maybe like subconsciously or consciously, you're like, okay, let me work. I'm a hands-on investor. Let me work with a team to make sure they do X, Y, Z. I guarantee you that is not going to happen, because what came out of the founder's mouth is what they're going to do. If something did not come out of their mouth, that's not what they're going to do. I think there's very little chance that the amount of influencing you can do it as investor is really going to change the way the team executes. So you kind of just have to vet the thing as if heard, not adding your own interpretation. And I think that's a tendency that early on, it's like operator turned investor, like that. Those are the types of mistakes that you make, and then you realize like, oh, they're not going to execute that way. So you have to prosecute the opportunity and the team just as is, without adding your own ingredients.
So as a fund, you believe in a very hands-on approach, right? But there are also funds on the opposite end of the spectrum, where the belief is that great founders do not actually need any support. Founders Fund, for example. So, and you also mentioned the really, really great founding team. they don't need much of a support, and also plus the fact that founders are not going to really go with whatever thing. So then, whatever that you suggest, then
what is our job? What do we do?
Yeah, exactly.
So here's what I would say: we're not here to build their business, and so if that's kind of what you pitch, the pitch is wrong. But I do think there are a couple things that great founders, and we have a lot of examples in our portfolio. Second-time founders know what they're doing. Founders who build unicorns and IPO'd and things like that. You'll be like, oh, they know exactly what to do. They've done it before. They've hired huge teams, they've scaled, and da-da-da. So for those examples, look, when you're, venture capital is a staged financing mechanism, meaning we don't just give a company $100 million, right? If a company needs $100 million in its lifetime, we don't just give the company $100 million because that's going to screw up the company. They're going to spend it if they have $100 million, not 3 plus 5 plus 50 plus whatever, right? So at the basic level, there's always like, who on my investor side is going to take the moral ownership of the investor syndicate and work with me as the founder and management team to strategize on the next round of financing. That's a very basic job of an investor.
Yeah.
And, I think if you survey founders who have been at it for a while, who raised what people call party rounds, meaning a bunch of small checks without a moral owner or a lead investor to really have enough skin in the game to really give a damn about what the outcome of the business, because everybody chipped in a little bit, is like not impactful for the fund.
Yeah.
Those founders were more likely to not tell you that, that was not great, because almost no early stage company's trajectory go like this. Every company, I'm waving my hand, but like every company goes through ups and downs in the very, very early days, concept stage, before they get a product market fit. There's almost no iconic companies out there. You could go back to the founder story. It's like, oh yeah, we just launched. The first thing we launched just took off. Like very, very few cases of that. So I think that's like job number one, is to really be the steady presence to support when it comes to not just like funding next round of financing, and help be like the moral anchor and the psychological anchor of that, and really be there to work with the founders on that. And, other strategic directions, like strategic decisions as well, because I've seen examples where their firms that models are not like us, there's not available or present at times of need. And I think especially in 2023 and beyond, the past 2 years, you've got to like wipe it out of your brain. Like, that's not the norm. This is the normal now. That was anomaly over the past decade. There's going to be more and more of these uncertain moments. And I think we, at the minimum, needs to be really like a steady presence. I would say the other, going back to kind of the operating, like, oh, so what does like hands-on actually mean? I think beyond the being a steady support, like we also, as a firm, have a pretty unique model where, we're an equal partnership. So working with any one of us is working with a part owner of the firm. And that is actually very helpful and powerful, because And again, at the moment of key decisions, we can make a call and get the firm's support behind it. And that's not available at, every single firm or every single partner you work with. On the tactical stuff, I tend to describe it in a way like, as a company, you make probably a thousand decisions a year or whatever not amount of that direction. And our job is to invest in teams that know how to bring the 10 most important decisions to the discussion table. And that could be informal check-ins or formal board meetings. And then we're there to hopefully, it's not like changing the complete trajectory of the business. If the business is going to go like this way, we're not lifting the curve up 50 or 90 degree. I kind of think about we marginally like lift the curve up 5 to 10 degrees by saving time. Like there are a lot of times where first-time founders or even experienced founders can save 3 months of mistakes just by like shortcutting on decisions that are hiring or that's on the product side. And hopefully we can be there to marginally impact that. But I don't believe that I don't believe that you're changing the trajectory of the business by like that much more. And our job is really to, being a founder is really hard because you're just thinking in your own head. Even if you have a co-founder, you're just talking amongst yourself all the time. You can't really talk to your employees. Your friends don't really understand what you're doing. Your parents don't understand. And your advisors are not deep enough and then talk to you frequently enough to have the context. So we're probably the next best in terms of showing up and have the context and at least can provide more zoomed out and macro perspective. But end of the day, the founders still got to, they decide what they do. But hopefully we have a slightly nuanced take on a particular decision that is something that helps with their decision-making process. Does that make sense?
Yeah. And also, I mean, the fact that you guys take very few number of concentrated bets every year, you're incentivized to make sure that the team raises the next round of funding, right?
Yeah, no, I don't think that is different. That is not to say that like if we make more investments, we don't care. I think it's the nuance there, at least the way we think about how we operate is that we can really spend the energy and bandwidth. A lot of times this is like a bandwidth issue. If, one GP is mapped to, done like 20 investments in the last 12 months, just by definition, you have to like choose where you're spending your time because you have legacy board meetings, you have companies that are running through all sorts of issues. And we like to make sure that we have the mental bandwidth as well as the actual calendar bandwidth to work with founders as needed. We try to really, only take on 2 to 4 new opportunities and relationships per year on a per partner basis.
Yeah. Even then it's difficult not to keep track of so many things.
Right. Well, that's our job, I suppose. But, I think, companies graduate from the C stage, right? So like at any given point in time, I have 5 or 6 things that are truly like pre-product market fit C stage that needs kind of more of active support, if that makes sense. And then company either stabilizes, they figure out their business model, or they raise the next round of financing, in which case I said, oh, you got new parents. And then, we step back a little bit in terms of being the active one in the driver's seat. Not to say we disappear and turn into pumpkins, but in fact, quite the opposite because we're usually the first institutional investor to have said yes to the company. There's the level of trust that, when founders need to navigate later stage investors and board dynamics, we can be there to support that because we don't have a dog in a fight, so to speak.
Yeah. And, could you share with me? So let's imagine this is 2020 March or something, beginning of COVID. One of your portfolio company was trying to raise the next round of funding. Then COVID happens. Then a lot of investors who had already committed to the round maybe pulled back. How do you help this company?
Mm-hmm. We had an example that's not exactly that, but kind of similar. We committed to a new investment. I think literally like the term sheet was issued the week before COVID, and then it was signed the week of COVID, something like that. We're leading a seed round of this company. And then the world shut down. So that's not the worst. The worst is that this company at the time was targeting restaurants and hospitalities. And of course, they had like 20K MRR by the time we signed the deal to lead the round. And then like basically MRR just disappeared overnight. I would say in the history of NextView, 100% of the time when we lead a deal, a syndicate gets done. Like we would socialize and introduce to co-investors, and 100% of the time that's always happened. This one was probably like one of the most difficult ones because, you know, everybody was like hiding in their shells, investors. And on top of like what the business looked like, targeting the sector that was completely shut. I think, you know, we stood by the term sheet and we just worked through the, you know, introducing to our friends and colleagues, you know, collaborators who would invest at this stage. And I think took like 3 months. The founder probably took another 50 to 100 meetings, if I remember correctly, but it got done. And I think that you know, our steady presence hopefully helped both the founder's psyche and as well as like the co-investor who eventually came in. But that was a very difficult situation. And that was something that I'm sure the founder did not want to live through that again. But I'm glad that, you know, the business is now post Series A and thriving. But that business could have died had we, you know, had that round not come together at that time. So
Yeah. And also, see, at that point, I clearly remember nobody had any idea how long this is going to last, right? So then, how did you
no,
have the conviction to help?
you know, kudos to the team. Like they were like really like I don't want to call it pivot. Like they really quickly evolved their product offering. And I actually think COVID, in hindsight, was a positive force in kind of accelerating that expansion of the product offering because they were forced to do it. And then they like got a team together and they launched a new product and they showcased how it went from like a pretty narrow slice of what they were doing to like, oh, we're actually building a platform and this is what we could do. Look, we already launched, you know, offering number 2. And I think that was very helpful in that particular situation. But I think that was just taught you that when founders' backs are against the wall, that you know, pretty magical things happen. And you know, and I think this founder also was, you know, I would call that her background was not your kind of Silicon Valley connected Silicon Valley type. Like did not work at a FANG, did not have like 30 angel investors as friends, but she was very good at the space that she was going after because she came from the industry of what she was trying to tackle. And I think that a lot of what we were doing at that point really like coaching her to talk to this class of people who are VCs and trying to prepare her for what are the questions that are going to come and how they're going to look at the data. And, you know, this is how I do cohort analysis and this is how I do layer cohort cake. And then to your point, like, yeah, she didn't know that before, but like she quickly picked it up. And, you know, when you're backing people who are more first time, you're looking for their ability to really learn at a very accelerated pace, because that's what founders have to do. Like every 6 months, your job is different. Your company grew, you have new challenges. You got to like figure out how to do X, Y, Z that despite, even if you like worked at FAME and was like, I don't know, VP of product, you still have not seen it because you worked at FAME. You did not work at a 2-person company who had to deal with X, Y, Z. So I think that the capacity to learn is another very important trait for early stage founders to succeed and continue to like evolve themselves because the job is different.
Yeah. I feel it's unreasonable. You know, you need to be good at a lot of things.
That's why it's not a job. You're like, oh, let me just be a founder. It's like, I mean, I've done an amateur version of this, but it's just psychologically draining, and you kind of have to be crazy. I don't mean like
Yeah.
mentally crazy, but you mean like you have to like see the world differently and just have the will to run through walls at a sustained for a sustained period of time. And that
Yeah.
usually requires a different way of like how you process the outside world and how you internalize that energy to really like accomplish the mission, so to speak, that you believe in.
Yeah. I came across this tweet of yours. So much talent is wasted by founders applying themselves to markets too small. Could you explain?
Yes. So it's kind of there's a literal statement that I think, a lot of times I meet founders and I keep a log of like all the companies I talk to and brief reason why I passed. And if you go into that log, you'll see quite a few of these comments like founders seem really strong, but the market is too small, or the market is unattractive. The counter argument is kind of what we just talked about in the beginning of the episode, which is there is a level of exceptionalness where you can just ignore the market. But I think that bar is very, very high because most of the time people start, let's say, oh, I am starting in the e-commerce space. And then like the current description of my company and product is this. It is very unlikely someone goes from like I'm working on something in e-commerce to building LLM ops doing prompt engineering tomorrow, right?
Yeah.
However, if you start something in the data space, like, oh, we're doing this part, solving this part of the problem in the modern data stack, I can see that they're like, oh, actually, this is not the right part, but this is the right part. This part of the data stack is the problem. Like that, I can see.
Yeah.
Like, so these two examples are, I think it just, when I say market is too small, like the overall, like the broadest definition of the space that you're in, given the founder's expertise and like how they arrived at that initial concept, you want to like figure out like if there's a broad enough of a pond to be swimming in. Because yes, you're going to like change directions 5 times, guaranteed. From like what people define as pivots to very small change of like, here's our product wedge, you go into market instead of that. So that I completely buy. But I think it's really tough. Small market is one problem. The other problem is like market is not attractive. Like what that means is there is no reason that this problem has not been solved, so that you're in there probably by mistake. That does not have a why now catalyst to really make it an interesting opportunity in 2023. And or that if you solved it, what you have to realize 5 years later is that, oh, it's not that great of a business. That's why nobody has done it. Or nobody has
Yeah.
succeeded at scale. Like no meaningful company has come out of solving that problem, even though the problem exists for a long time. So I think I also really try to pay attention to whether this is an interesting problem to solve at this time. But I think a lot of times, like, I just feel like founders go through the idea maze. And then at some point they like cross the chasm of committing. And then once they like commit, they ignore the signals that are telling them no and only like partially accept the signals that are telling them yes. And I've made that mistake myself before. Like I was working on
Yeah.
something that was like the market really sucked when I was a founder. And at some point you just try to ignore it and you like partially accept the signals that are additive to your case. And then like, then this talent, hopefully like I wish this talent was working on something that can give them more of an upside and a attackable TAM, right? As opposed to what they end up working on. But I feel like, not just us, I feel like many investors meet folks that really like the team, but could not get behind the market. I think that's a pretty common reason for passing.
Yeah. So your thesis at NextView, everyday economy. Could you walk me through uh, it and the kind of things that you look at.
Yeah, it essentially really just means that we're more problem space first investors as opposed to technology or business model. We're problem space first investors, and the problem space we care about are really these habitual and pervasive moments in everyday workers' lives, how you work, how you get work done, different types of workers, data engineers, product people, marketers, sales folks, frontline workers, doctors. They're all very different in terms of how they get work done. And then when we're not at work, we're the everyday consumer. So we think about everyday consumer concerns. We think about sleep, health, caregiving. We think about home buying. We think about home maintenance, transportation, food, shopping, how we make shopping decisions. How do we stay, not lonely, and, mental health. How do we save and invest, money management? These are all very important moments in our everyday lives. So we invest both at the application layer that directly tackle those, what we call broken user experiences in these habitual moments. And we also do things that are a layer below. So think enabling technology. So that could mean API layers, that can mean B2B2B, that are indirectly powering those, but behind the scenes that the end user, whether it's an end worker or an end consumer, might not know directly. So that's kind of it. There's a pretty broad lens that we look through. And, as a result, there are a few things that we tend not to do. Either is like 2 layers deep in the infra layer that is too remote from the problem statement, or things that are, too enterprisey like cyber, or things that are not very pervasive. So it's a very small slice of the population. So things are like luxury in nature, that are not very frequent or not very pervasive. And then the only other thing we care about is like, what is the application of technology? And then we hope that there is technology leverage that is part of the solution to the problem.
Yeah. So in short, it's something like products and services that you use routinely, but for the masses, for the mass market. Is that the way
Sure. Yeah.
to put
I
it?
mean, I think a large enough of a slice of the population, right? So
Yeah.
again, it could be a slice of a worker population. It could be a slice of the consumer population. So we're just thinking about problems that are at work and problems at home, and what can still be 10x better through leveraging technology to solve that. And that could mean boring B2B SaaS companies. That could mean marketplaces. That could mean fintechs, APIs. That could mean hardware company with a software business model like Whoop. That could mean digital health like Devoted Health, which is the Medicare Advantage program. That could mean really deep tech stuff like we have a company that is building a software layer to manage lithium-ion battery, enterprise-grade lithium-ion battery fleets out there for performance and safety. We have a company that's building software-driven LiDAR technology on chip, so precision on chip for autonomous driving as well as autonomous robotics. And that's very enabling technology layer, right? But then, like, for example, the framing of that company is really, if there's going to be an autonomous future in terms of productivity enhancement, in terms of having ADAS in passenger cars that is economical, then this is the type of technology that can unlock that. So that's kind of how we think about the world. So I think it's more of like how we approach the framing as opposed to like the end product of the types of company we invest is not super dissimilar to most of our peers, probably. But I think the way we prosecute and the way we think about important problem spaces is that we come in with more of a prepared mind, and we try to surround those problem spaces with different types of companies and business models and applications of technology.
Yeah. And you also mentioned, you don't invest in infrastructure layer that are removed from the users. What are those infrastructure layer?
Like a database company, right? Like, oh, they're, with LLMs, vector databases are in vogue, and there are probably great businesses, MongoDB, great business, but we're just not the natural investors for stuff like that. But we do invest in the API layer, so a layer above. So like think of a layer right below the application layer. Yeah.
You also have an accelerator. Why do the accelerator? Why run an
Yeah.
accelerator
So
program?
we've always done things at a concept stage. So we were, despite the growth in fund size and having been an institutional seed investor for a dozen years, a lot of our peers have moved up the stack, so to speak. They kind of wait for post-launch and more traction, and then they, given the fund model, they don't really want to cut really small checks to invest in true pre-seeds and take on additional risk and work. But we've always really enjoyed the concept stage and pre-launch style companies. And the idea for accelerator is really that I call it like a very structured pre-seed investing program, meaning it's not like the actual deal itself is not dissimilar to some of our pre-seeds that we do. Lead a 500K round with 300K check, or lead $1 million round with 750K. But it has two distinct aspects to it. One is, as you know, in venture is very referral and network driven. And there is a reason for that, because the inbox is too crowded. Investors don't have the bandwidth to process every single theoretical opportunity comes at you. So we have to rely on some kind of filtering mechanism to prioritize. Now, I also recognize that extremely annoying, because that really kind of further concentrate the access in dollars in the hands of people who already have access in dollars. So the accelerator program that we do is really the only opportunity for NextView to have an open casting call, that we review every single application that comes in, regardless whether it's people we know or not. And we feel like that is a necessary thing for us to do, to have a mechanism that is manageable for us. We don't do it all the time. We do it once a year, that we can really engage the broader community beyond just our immediate network. And the other distinct aspect is that it is slightly more structured compared to our average pre-seed. And, they do have this cohort that just graduated a couple of weeks ago. Is a cohort of 7 companies. So it is kind of like a boutique anti-YC style. I don't mean by like, oh, we're going to do everything opposite of YC, like tremendous respect for them. But we try to make it really small. And each of the GPs on the team takes on 1 or 2 companies. So we have 5 partners. So each partner is pulling on 1 or 2 companies. And I think we have some programming around that, are mentors and talks and conversations that are hopefully directly helpful to companies at this stage. And then they also get a peer group, which, being a founder is a very lonely journey. And then we talked about how we strive to be a source of stability and trust as an investor.
Yeah.
But at the end of the day, we are investors. We're not founders, right? So there are certain things that you don't really want to talk to your investors about, and you want to have outlet that is more of a peer support. And in this format, they get that, and they can really amplify the support with each other. And we're doing that, by the way, outside of our accelerator program, increasingly as a broader NextView portfolio. We try to really figure out a systematic and structured way to help our founders support each other and build really genuine, trusted relationships. But that's the reason why we do an accelerator program, and it's a standard deal. The one that we just, the past 2 cohorts were 400K at a 4 cap. And, a lot of times we're the only lead investor in the effective round. And we do a ton of legwork in terms of preparing the company when and if they want to fundraise. And then we introduce them to all of our peer funds. And then we say, hey, we tell everybody externally that we're not going to lead anybody's next round. But we are usually the receiving end of this kind of pitch at this stage. So we feel like we can really prepare them to talk to investors that are just like us when they need to. But then we said, we're not going to lead any of their next rounds, because we don't want to bias the market and cherry pick the favorites. But we will do our pro rata when the outside led round comes together. So I think of it as a really 12 weeks of like very structured and frequent. And we talk to the point partner talks to the companies every week. So in fact, it's like more work during an accelerator time than like our average seed or pre-seed investment. And then after that, we graduate to more of a regular cadence that's more similar to like a true pre-seed investment for us.
Yeah. And you also specifically go out looking for the alumni pod track. That I thought was really interesting, looking for founders who have studied together, worked together. I guess the thought is, there is a lot more trust and a lesser chance of a breakup if you've already studied together, worked together.
Yeah, the idea is that you really de-risk the team building, and you kind of like bring your mini Avengers together of your past lives, right? So hopefully that de-risks a lot of the friction around working together, and you can just get right to it. And I think one of the key risks for early stage company is the co-founder risk and the drama associated with that. I think there's probably some stats that 30% or something of early stage teams end up breaking up or having some kind of founder issue of some sort. So that was kind of the idea. And I think the other idea that came out that really propelled that concept was really that, hey, there might be people that have been on the sidelines and they just needed a catalyst and a push to give them a structure to jump in together. So that's kind of the idea. And then the team that we got one alumni team out of the 7 of this cohort that just graduated, and we had no one of the two through our network, and we were like, oh yeah, he reached out. I was like, hey, yeah, so it's accelerator, this alumni pod thing. I have this tech lead that I worked with 2 jobs ago that I've always wanted to start something together. And maybe this is an opportunity for me to go talk to him, even though we don't have an idea yet. So that's kind of the intended consequences of the program, which served as a catalyst for them to be in an environment to start ideating. And then, I say in the middle of the program, they came up with a direction to go after. So that was a pretty interesting experiment for us. I think we'll continue to do that.
Yeah. And also you mentioned about true pre-seed. So there are pre-seed, then there is this post pre-seed, seed plus, seed 2, seed extension, pre-seed, pre-series A. What does all this mean? Briefly.
Well, I didn't. This is all founder made up these names. I did not, but I would say at a very high level, we think about it. If it's a pre-seed, it's your expectation that the next round is a seed round. Okay, so what does that mean? That means that, like, given the business, given the amount of dollars that go into that very first round, do we think that there is a high probability that you're going to hit a C stage milestone or a Series A milestone? So I'll give you an example. Like,
Yeah.
If it's an enterprise company need to sell into true enterprise and raise $2 million, their first round is raising $2 million. Given the environment today, and then let's say that you back this team concept state, $2 million hit. Given the complexity of the product they need to build, the enterprise customer sales cycle, the ACV, the need to land, the ARR metrics, it is probably, without knowing the next level details, exactly what this company does, just on a surface level, that probably effectively is a pre-seed. Yeah. But then again, it doesn't really matter. It doesn't matter what you call it. Like, it's just so that there's a mutual understanding that the next round is probably a $3, $4, $5 million seed, because it's unlikely that $2 million concept stage for a very enterprise product can get to the Series A milestone. Maybe they could. Then they skip it and it goes straight to A. That's totally fine. But I think if you're raising anything below $1.5 million, I think you can clearly call out a pre-seed with a straight face and that people will not look at you funny. If you're raising a $3 million round and you call it pre-seed, people might look at you funny. And that is where it gets into gray area, because 3 in theory is enough to do a lot. So if you call it a pre-seed, then there's implied expectation that you're not going to use the $3 million to get to your Series A milestone. So that might become problematic in some investors' mind. Again, business model dependent. What ended up happening in reality, right, especially the past couple of years, is that people raised whatever amount, and then they thought, oh, we're going to be able to just raise an A without much of attraction or just based on hype, but depending on what space they're in. And then the market turned and suddenly the standard changed, which is not very fair. So a lot of companies are probably in a situation where they thought they could get to an A, but the A milestone is being pushed out because the A investors are skittish and waiting for the perfect pitch at the moment.
Yeah.
So that these companies thought they were going to do an A and then they end up raising a second C. So that's all these funny names that are out in the market. You know, another extreme is like if you're like a more, you know, if you're founded with some kind of track record and you came out of gay raise a $5 million round, which we've been part of it for a couple times in the past, 12 months, then your next stop has to be A. Like, you raise $5 million. People judge you based on capital in, total capital in time, right? It's like, here are the ingredients that came in and here's the output. I'm going to judge based on like how long that took, how much resource it took, and what did you produce with that. So whether it's one round or 2 rounds, it kind of is just that, right? Like, so people judge you on a collection of that. And then the time that's lapsed, because that shows like how fast you execute and how much wander in the woods you did, which is kind of a waste of time, but sometimes it's necessary to wander in the woods before you come out and like get to something. So I think that's kind of how I think about it. End of the day, it kind of doesn't matter in terms of what you call it. It's just dollars in, and then people are going to judge you based on the output. But it is problematic if you're like a tired, quote unquote, tired company that you've been around for a while, and then you keep raising these like incremental rounds, and people are eventually going to look at you funny. It's like what happened there?
Yeah. So one last thing. So I know you're a recovering founder. But if you were to start a company tomorrow, which 3 VCs would you call, and why?
Yeah. If I can't call NextView, that is. I would say that a couple of people came to mind. One is Hunter at Homebrew. Homebrew, the reason is I really enjoy him as a human being. And I think that's kind of one of the most important things. Like, I feel like it's someone who is genuine, who I feel like I can trust, that we're going to have a good working relationship with. I've actually never invested with him on a deal, but I know him over the years as investors, and I just feel like we're of the same wavelength. And Homebrew changed their model, so they just invest in their own capital. So it's a little bit like family office, which also gives them a lot of flexibility. I know it because I'm at a institutional LP-backed fund, and we have certain like fund deploy model, ownership targets, and things like that. And I know that they can be pretty flexible because it's their own capital. I mean, they still want like venture return, but they're not running a finite size fund. So that gives them interesting flexibility. And he's a true seed investor. There's no, I think, given my role, I have a strong bias against talking to true Series A or multi-stage firms at seed. The second name, this is a little recency bias. I just saw him. So I just thought of him. Gautam Gupta at TCV. So TCV has a late stage fund, but Gautam is at an early stage version of that. I forgot his exact name, but it's like a separate vehicle that he was also a founder. And similar reasons, we're off the same wavelengths. I like him as a human being. His fund is more of a Series A investment. So it might not be good at like concept stage, but I feel like he can give me pretty genuine and open advice and be able to kind of be a support and probably even like do an angel size check, which is interesting. And then the third slide, I think I reserve to like, depending on what I'm doing, because I think there are people that I could think of, like, if I'm building a marketplace, now I have these people I want to talk to. If I'm building a digital health company, if I'm building a fintech for company concept. So I think that I'm usually, because we're a generalist, again, here's my personal bias. Like, I actually think the best investors are multidisciplinary, but I think depends on the problem space I'm tackling. There might be some folks that have a very specific set of network and know-how, especially in more highly regulated industries like healthcare and fintech, that can supplement my existing network and know-how. So I think the third slide, this is a little bit of cop out, but the third slide is probably reserved for, depending on like the business model, because there are folks that are going to be very specifically helpful
Specialized.
and valuable. Yeah, given whatever
Yeah.
I might be doing. But to be clear, I'm pretty happy as an investor. So, hopefully being an early stage investor side is my last job. But this is a fun question nonetheless.
Yeah, this is fun. Thank you so much for taking the time again to do this.
Yeah, no, thank you for having me. Glad to be on the show.